Welcome to Pure Riches. We are diving back into the fundamental steps of financial mastery. Today's deep dive begins now. Welcome back to the deep dive. We are really ripping open a massive stack of knowledge today, all centered around financial literacy and, the fundamental, sometimes pretty controversial strategies that separate true wealth from the day-to-day struggle of the middle class.
That's right. And our core source material, it hinges on this fascinating contrast. The lessons learned from two very different mentors. You have the highly educated, quote, poor dad on one side.
And the street-smart, financially savvy rich dad on the other.
Exactly. And it's such an essential juxtaposition because the mission here isn't just, telling a story. Our goal is to really distill the six main lessons, the mechanics, and maybe more importantly, the mindset shifts that fundamentally delineate the rich from everyone else. And the essential immediate insight that kind of frames this whole conversation is this. The main reason people struggle financially isn't a lack of opportunities or even a lack of hard work. It's a profound deficiency in financial education.
Right. An education that critically is traditionally taught at home, not in our schools.
Not in our schools at all. And that's the gap, that's what makes this material so compelling. The sources point out that even highly educated professionals, people who are brilliant, doctors, lawyers, top government officials, they can be completely financially illiterate.
It's because schools prepare you for scholastic and professional success.
Yeah.
But they completely neglect teaching the actual language of money, which is, accounting and investing.
Think about the irony there. Society rewards that scholastic achievement with these high salaries, but then those same high earners, they use their complex intelligence to rationalize really simple, destructive financial behaviors. The source material even points to things like national debt and economic fragility, arguing that highly educated politicians who often have zero specific training in capital management or asset flow are making these huge global financial decisions. And they're using a framework meant for an employee, not for an investor or a business owner.
And that really highlights the immense benefit the student in the story had, right? Having two opposing, passionate mentors. I mean, if he only had poor dad, he would have just accepted the traditional path, go to school, get a safe job.
For sure. And if he only had rich dad, he might have been, seduced into following a risky, unconventional path without any kind of grounding.
Exactly.
So having these two powerful, charismatic fathers, each one preaching a diametrically opposed view of money and life, it forced him to engage his critical thinking. He had to think, he had to compare, and ultimately, he had to choose a path for himself.
Instead of just accepting or rejecting one viewpoint.
Right, that ability to choose for yourself, to question the status quo, that is so much more valuable than just absorbing a single piece of advice. It creates an internal framework for making your own decisions.
And the philosophical divide, it really started with their language, with their deepest core beliefs. Poor dad, despite all his advanced degrees, struggled financially his whole life, and he embodied that struggle by saying, the love of money is the root of all evil.
Well, Rich Dad, the high school dropout who became one of the richest men in Hawaii, he offered this direct, really provocative counterpoint. The lack of money is the root of all evil.
That is an immediate, visceral statement. It just completely shifts the emotional landscape of the conversation around wealth, doesn't it?
It totally reframes it. Money isn't this inherently corrupting thing, but, a necessary tool, a tool for freedom and a defense against unnecessary suffering.
And here's where the practical application of this philosophy gets really interesting. It connects language directly to your financial outcomes. Poor dad, for instance, had a habit of using phrases that they signaled finality, especially, I can't afford it.
Oh, yeah. Rich Dad recognized that phrase as poison. It's a sentence that literally shuts down the most powerful tool you have, your brain. He insisted on replacing it with a question.
How can I afford it?
How can I afford it? That shift, just from a statement of fact to a question, is a monumental difference in action. I can't afford it, as the source notes, is a sign of mental laziness. It just lets your mind quit.
Whereas the question, how can I afford it, forces the brain, which Rich Dad called the most powerful computer in the world, to start actively working, to problem solve, to generate creative solutions.
It puts the brain to work.
So if financial success starts with that mental exercise, with overcoming laziness, that leads us directly into the first major lesson. Lesson 1. The rich don't work for money.
This is probably the most famous and foundational teaching. It's introduced through the concept of the rat race. The narrator describes this as a fixed, monotonous loop. Get up, go to work, pay bills.
Get up, go to work, pay bills. Over and over.
Right. And this entire life pattern for the poor and middle class is fundamentally controlled by two powerful primal emotions: fear and greed.
We see that loop every single day. I mean, people are motivated by the fear of not being able to pay their bills, so they work harder, they endure jobs they might hate. Then, if they get a raise, greed kicks in. They want a little more luxury, so they increase their spending, take on more debt, and they lock themselves into a higher stakes version of the exact same trap. That's lifestyle inflation in action.
And the trap is that increasing your income just increases the size and the complexity of the cage you're in. They earn more, so they spend more, and the underlying financial insecurity it remains. Or it even gets worse because their liabilities are now greater. They're still running, but the wheel is just bigger.
Rich Dad really drove this lesson home with it was a deliberately cruel psychological experiment, wasn't it? The 10 cents an hour lesson.
It was. He paid the young boys that measly wage, and then he revoked it entirely. Just left them confused and resentful.
Why? What was the point of that?
That experiment, it was designed to give them a concentrated taste of the employee life. He wanted them to feel the anger, the frustration, that sense of powerlessness that comes when you realize you're working hard for someone else's system.
And your survival is dictated by a paycheck that can be taken away at any moment.
Exactly. Most employees, the source notes, they spend their lives asking for a job, asking for a paycheck, but they never ask to be taught about money or the system itself. They're just exchanging time for security, which is, well, it's a very fragile currency.
So when the narrator inevitably complained about the unfairness of it all, the low pay, the boss Rich Dad offered that crucial, empowering shift in perspective. He said, stop blaming the external factors.
Right. Stop blaming the job, the boss, the low paycheck. Realize that you are the primary factor.
Which is. That's the turning point for all personal development, isn't it? Not just financial.
It is. If you blame the external world, the government, the job market, the economy, you're powerless. You can't change your situation. If the boss is the problem, okay, you might change bosses, but you'll probably just recreate the same dynamic somewhere else.
But if you are the problem,
then you can change yourself. You can learn, you can adapt, and you can grow wiser. That ownership of the problem is the ownership of the solution.
And he beautifully summarizes the difference between a temporary condition and a permanent state when he says, there is a difference between being poor and being broke. Broke is temporary. Poor is eternal.
Poor is that mindset. It's defined by those dependent thoughts and actions that keep you shackled to the paycheck.
So that mindset shift is the prerequisite. Once you accept that working hard for money is the trap, you need the tools to figure out what working hard for yourself looks like.
Right, and that means moving past emotion and into mechanics. Which brings us to the foundation of financial success in Lesson 2, financial literacy.
Lesson 2 establishes that true financial success isn't measured by the size of your annual income, your W-2 statement, but by financial endurance.
It's not how much money you make, it's critically how much money you keep. And maybe even more critically, for how many generations you keep it.
That longevity principle is so often ignored in this modern rush for quick riches.
Totally. The source references this famous cautionary tale from 1923 when a lot of the richest businessmen in the U.S. gathered in Chicago. You know, figures like the head of the largest utility company, the president of the largest steel company, the greatest wheat speculator.
Titans of industry.
Yeah, titans. But you fast forward 25 years, and many of those men, they died penniless or spent their final years in poverty. A high income is just irrelevant without a secure, literate foundation.
That story really warns against trying to build this enormous structure without understanding the physics of the base. Rich Dad uses an analogy I love to explain this. He talks about trying to build the Empire State Building on a 6-inch slab of concrete.
It's such a powerful visualization. Most people, they see the massive wealth others have acquired and they try to rush into high-value investments, the penthouse, the expensive portfolio, without any of the foundational knowledge.
And financial literacy is that deep, concrete foundation.
It is. If you want to be rich long-term, accounting, the ability to read and understand the numbers on a balance sheet and an income statement is arguably the single most important subject, even though, most people see it as tedious or boring.
Okay, but accounting is complex. So how do you simplify this seemingly confusing, boring subject into a guiding principle that even 2 young boys can use?
This is the genius of it. Rich Dad distills all of accounting down to one single essential truth. Rule number 1, you must know the difference between an asset and a liability, and you must buy assets.
That sounds almost absurdly simple.
Yeah.
Yet it's the core rule most educated people fail to follow. Why is that?
Because they confuse the two. The profound reality is encapsulated in this quote. Rich people acquire assets. The poor and middle class acquire liabilities that they think are assets. This is the point where conventional wisdom just crashes head-on into financial reality.
Okay, let's nail down those rich dad definitions then, which are entirely based on cash flow, not some complex dictionary term.
Exactly. The simple definition is the key to actually applying it. An asset is something that puts money in my pocket.
Yeah, I'm a liability.
Is something that takes money out of my pocket. That's it. If your goal is wealth, your life has to be dedicated to acquiring items that fall into that asset column.
So why does this trip up so many intelligent, well-meaning, educated adults? They hear that definition and think, of course I know that. But then they continue to fill their lives with liabilities.
Well, the source material offers two really critical reasons. First, they're educated by professionals, bankers, real estate agents, accountants, who use these formal dictionary definitions that are, okay, technically accurate, but useless for day-to-day financial decision-making.
The definitions are intentionally complicated.
Right. It creates a layer of necessary expertise. And second, and this is maybe the harsher critique, the simplicity of the cash flow definition, often just. It escapes them because they feel accepting it is demeaning.
So they're too proud to unlearn the complexity they paid for in school.
It's like they feel accepting the KISS principle, keep it simple, stupid, is beneath their intellectual status or something.
That seems a little harsh, though. Calling highly educated people too proud to learn a simple rule? Isn't the real struggle just that their professional skills don't translate to financial success? I mean, they're great at medicine or law, but they've never been trained to manage capital.
That's an excellent point. It might not be pride so much as comfort. They're comfortable in their own domain of complexity. So when they enter the world of money, they look for complex solutions because, they associate complexity with value.
Yeah.
But Rich Dad insists that the greatest fortunes are built on simple, repeatable processes. If you can't understand the simple cash flow pattern, the complex investments will only make you lose money faster. The complexity is often just used by financial salespeople to obscure the underlying negative cash flow.
So if the words and the complex definitions confuse you, Rich Dad's advice was to look past them and see the story the numbers tell through the cash flow pattern. Let's try to visualize those patterns for our listener.
Okay, so if you look at the poor or middle class cash flow, you see a cycle that's driven by earned income. The money comes in, but it immediately flows right back out. It bypasses the asset column almost entirely, going straight into expenses, food, utilities, taxes and liabilities, mortgages, credit card debt, car loans.
They work hard to generate income, but that income is immediately just eaten up by debts that are disguised as necessities.
Yeah.
Their liability column is huge and is constantly draining their pockets.
It's a bucket system. You keep hauling the bucket, but it's full of holes. Now, Rich Dad's cash flow pattern is completely different.
How so?
His system is a pipeline. Income comes in, but the primary allocation is channeled directly into the asset column. These assets, whether it's cash-flowing real estate, dividend-paying stocks, a business you own, intellectual property, they generate their own income.
Rental income, royalties, interest.
Exactly. And that asset-generated income then flows back into the income column. The whole goal is to build an asset column so robust that the income it generates completely covers all of your expenses, which makes physical labor, your job, irrelevant to your financial survival.
This brings us to the biggest emotional hurdle in Lesson 2, which is the house. Rich Dad directly challenges the conviction that our home is our largest investment and our greatest asset.
Absolutely. It is the single most sacred cow of conventional finance. And Rich Dad argued unequivocally that the house you live in is generally a liability because, using his simple definition, it takes money out of your pocket every single month.
Okay, I think we need to linger here for a second because the emotional attachment people have to their home is profound. People will argue, but it appreciates, or I get a tax deduction.
Right. And this is where true financial literacy provides the nuance. Yes, a house might appreciate, but that appreciation is only realized when you sell it, and you might have to wait decades for that. Meanwhile, the cash flow story is negative every single month.
You're talking about the mortgage, the insurance.
Consider the true Jane. You have the monthly principal and interest payments, and most of your early payments are pure interest. You've got property taxes, insurance, maintenance, and repairs, which are non-deductible and constant.
And utility costs.
All of these are dollars flowing out of your pocket.
Which leads to the concept of opportunity cost, the thing that's often forgotten in the excitement of signing those mortgage papers.
Precisely. If that large down payment or all the extra cash you spent on landscaping and upgrades had been placed into a productive asset, a diversified stock portfolio, or a small rental property, it would be generating income for you immediately. When you pour all your money into an enormous non-cash flowing home, you are sacrificing that future income potential. Rich Dad's stark warning was, if your house is your largest investment, you're in trouble because you're prioritizing consumption and maintenance over income generation. The rich may own large homes, but they first acquire the assets that pay for them.
That clarity on the rules of the game, asset versus liability, it paves the way for the next phase, which is strategic action. Lesson 3 is all about focus on the asset column, or as he called it, mind your own business.
This is the practical application of Lesson 2. The tendency of the poor and middle class is to focus exclusively on their income statement, how much they earn. They chase raises, promotions, better jobs. They're perpetually focused on the E and S quadrants of the cash flow quadrant.
Employee and self-employed.
Right. Rich Dad argues that minding your own business means devoting your time, your energy, and your resources to building and keeping your asset column strong, regardless of what your day job is.
The trap, then, is that financial struggle results from people working their entire lives, not for themselves, but for other people. Let's break down who is really benefiting from all that hard work.
Well, first, you're working for the owners of the company who employ you. Then you're working for the government, who takes a huge chunk via taxes right off the top.
And you're working for the bank, which holds your mortgage and your credit card debt.
Exactly. The source makes a strong point. At the end of 40 years of service, the poor and middle class often have nothing substantial to show for all their efforts in the asset column, because they were focused entirely on generating earned income that was immediately consumed by expenses and liabilities.
So the core philosophy here is to create employees, but those employees are dollars.
The power of the employed dollar is a core concept. Rich Dad stresses that once a dollar goes into your asset column, it buys a share of stock, a piece of real estate, whatever, it becomes an employee. It's working 24 hours a day, it never asks for a raise, and it will keep working for generations.
So the advice is highly pragmatic. Keep your day job for security and to feed that asset column, but never, ever stop actively building that column. The day job is just a means to fund asset creation, not the end in itself.
That's it. And this concept fundamentally redefines how you should approach purchasing things, especially luxuries. The distinction here is key because it's not that the rich don't enjoy luxuries, it's when and how they acquire them.
Right. The rich buy luxuries, but the sequence of spending is totally reversed compared to the middle class.
The rich buy luxuries last. They use the income generated by their robust, established asset column. The assets generate the cash flow, and that cash flow pays for the luxury car or the big vacation. It's the difference between buying a liability and buying an income stream.
Whereas the poor and middle class buy luxuries first, often on credit, to look rich. They create the illusion of wealth.
They buy the new car, the oversized house, the expensive jewelry, and they incur these huge debts. They're paying for these items with their own sweat, blood, and future time, which just locks them back into the rat race. They buy status symbols, which are liabilities, while the rich buy assets that generate the cash flow to pay for those same symbols without ever touching their principal capital.
So the rich man's luxury is paid for by his money.
Yeah.
The middle class person's luxury is paid for by his time.
Precisely.
Okay, so if minding your own business and building assets is lesson 3, then lesson 4 introduces the necessary, often overlooked strategy. Understanding the financial power structure and using corporate structures to your advantage. This deals directly with what Rich Dad calls the biggest bully.
And the biggest bully is the tax man. Financial ignorance is what allows the government to take more from you. This lesson is a deep dive into financial IQ and the legal advantages that are afforded to the wealthy. It's about how the rich play the game using the corporation, a perfectly legal structure, to minimize tax exposure in ways the average employee doesn't even know exist.
Rich Dad's philosophy on taxes is pretty critical. He argues that the system punishes those who produce earned income and rewards those who are financially savvy enough to structure their income differently.
Right. Historically, income tax was originally levied in the U.S. and Britain just to fund wars, and initially it was targeted only at the very rich.
The idea was to tax only the top earners, and only temporarily.
But the government quickly realized the political ease of taxing the masses and the tax burden just. It gradually migrated down to the middle and lower classes. Rich Dad asserts that the rich eventually outsmarted the intellectuals, the people advocating for high social taxes, by understanding the legal power of the corporate structure. It allowed them to legally minimize what they paid. They found ways to play by the rules, but the rules are written to benefit those who structure their finances like a business.
Okay, I think this is a point where we need maximum detail because this is the specific mechanism that the rich use. An employee, the E quadrant, earns money, then pays taxes, then pays expenses. How does a corporation or business owner, the B or I quadrant, reverse this flow to their advantage?
The flow is fundamentally different, and that's where the massive legal advantage comes from. An employee earns, say, $100,000. The government immediately takes, let's say, $30,000 in income and payroll taxes. The employee then has to use the remaining $70,000 to pay for everything: housing, transport, food. The employee pays tax first.
But the corporation or asset owner does the reverse.
Exactly. The corporation earns $100,000 in revenue. The corporation is legally allowed to pay its expenses, its operational costs, and even for its assets first. It pays for travel, equipment, training, all these legitimate business write-offs. Let's say those expenses total $40,000. The corporation only pays taxes on the remaining $60,000 of profit.
And crucially, many of those expenses are things the owners and investors would have bought anyway, but now they're tax deductible.
You're essentially telling the listener that the rich get to spend their money and then pay tax on what's left, while the poor and middle class have to pay tax on everything and then try to afford their lives with what's left.
That is the core legal and mechanical difference separating the quadrants.
It is. And furthermore, you have to understand the three main types of income, because not all dollars are created equal under the tax code.
Okay, so first, we have ordinary earned income, the wages and salary you get for working a job.
This is the highest taxed income category. It's subject to income tax, Social Security, Medicare taxes, all the ordinary income tax rates. This is the income of the employee and most of the self-employed.
Then second, you have passive income, primarily from cash-flowing assets like real estate.
And passive income is generally the least taxed income, particularly in the U.S., because real estate allows for enormous legal write-offs, specifically depreciation.
Explain depreciation.
It's an accounting concept where you deduct the value of the property over time, on paper, even if the property is actually increasing in value in the real world. This can often shield most, if not all, of the rental income from taxation. Sometimes you can even have a tax loss on paper while you're actually receiving positive cash flow in your bank account.
And finally, there's portfolio income, which comes from paper assets like stocks, bonds, mutual funds, money working for you.
Right, which is usually subject to capital gains rates. The key to wealth acquisition, according to Rich Dad, is understanding how to convert that highly taxed ordinary earned income into passive or portfolio income as quickly and as efficiently as possible. When your money works hard for you, it gets taxed significantly less than the money you work hard for. That conversion process is the fundamental game of the wealthy.
We've moved from mindset through accounting, through strategic tax planning, and now we get to the almost shocking philosophical premise of Lesson 5, the rich invent money.
This starts with probably the most challenging philosophical statement in the entire source. Money is not real.
What does that even mean?
It's simply what we agree it is. If you believe money is a fixed, tangible resource, you'll work harder and harder for it because you see yourself as competing for a finite supply. But if you can grasp that money is simply an idea, a measurement of value, you realize you have the ability to create it.
And the source material argues that the tool for this creation is the human mind. It's the single most powerful asset we possess. A well-trained mind, especially in our information age, can create enormous wealth almost instantaneously just by recognizing patterns and opportunities that everyone else misses.
It's the difference between waiting for luck to strike and proactively creating the conditions for success. You want to be the kind of person who creates your own luck. Great opportunities are not seen with your eyes. They're seen with your mind, with your financial intelligence.
And most people miss them because they're too focused on immediate needs, on security, or on money itself. They're looking for the job and the paycheck, so that's all they ever get.
While the rich are looking for problems to solve that create systemic value.
To truly invent money and seize these unseen opportunities, you need specialized skills, financial intelligence, that go beyond general intelligence or professional knowledge. The source identifies 4 core components you have to develop.
These 4 pillars define the successful investor, the I quadrant, and the business owner, the B quadrant. First is accounting, which we've already discussed. That's pure financial literacy, the ability to read and analyze the numbers to understand the true flow of cash.
Second is investing, the science of money making money. This moves beyond just saving into knowing how to allocate capital and structure deals that minimize risk and maximize returns.
Third is understanding markets. This is the science of supply and demand, knowing what the market wants, when it wants it, and being the one who delivers. Think of the timing and vision of people like Bill Gates or Alexander Graham Bell. It's about anticipating massive shifts and positioning yourself correctly.
And finally, law, an awareness of corporate, state, and federal regulations. This isn't about becoming a lawyer, but knowing enough to legally leverage tax codes, protect your assets, and understand contracts.
That combination of skills is what allows a person to see a dilapidated building, not as a maintenance headache, but as a 5-unit rental property with favorable depreciation schedules. That is inventing money through applied knowledge.
But the biggest barrier to applying this financial intelligence is internal, right? It's that intense, paralyzing fear of losing money.
That's where our educational system actively hurts us. In school, mistakes are bad. You get punished for them with bad grades. But in the real world of financial learning, mistakes are essential data points.
You learn to walk by falling down. You learn to ride a bike by falling off.
Exactly. Winners are willing to fail. They analyze why they failed, they learn from that failure, they adjust their strategy, and they move on. They recognize that losing money only makes them stronger and smarter as long as they treat the loss as a lesson, not as some final judgment on their abilities.
So lesson 5 really demonstrates that the rich are not necessarily the smartest people in the world in the traditional IQ sense. Often it's the bold, those willing to take action and calculate risk, who get ahead of the academics who are just too terrified to risk making a mistake.
Absolutely. The rich are, ironically, often the biggest losers, meaning they have failed more times than the average person has even tried. But they fail small, they learn big, and then they hit big.
So even if someone internalizes all these intellectual lessons, they know the difference between assets and liabilities, they understand corporate structures, they're willing to take risks, they still might not achieve financial independence. And that's because of the internal emotional roadblocks, which we're going to dive into now.
Yeah, the difference between the financially free and the financially stagnant, it often just comes down to how effectively they manage their own internal resistance. The sources meticulously list 5 common internal reasons why even financially literate people fail to develop abundant asset columns.
They are.
1, fear. 2, cynicism. 3, laziness. 4, bad habits. And 5, arrogance.
Fear is number 1, and it's a deep, primal pain. For most people, the pain of losing money is just profoundly greater than the joy of being rich. It's easier to live in fear and maintain security, the comfort of the status quo, than it is to risk failure and actively pursue your dreams. How do the sources suggest we manage this innate resistance to risk?
Rich Dad encourages using fear and failure as inspiration, not as an excuse for inaction. He used the story of the Texans at the Alamo, a catastrophic military failure that cost every single man his life. But what did Texas do? They turned it into inspiration, a rallying cry, and today it's a massive tourist destination that generates millions. They capitalized on the idea of the failure.
So financially, the key is to manage risk instead of avoiding it entirely.
Right. And this means focusing your energy. He uses the acronym FOCOS. Follow one course until successful. Don't dilute your efforts by putting a few dollars into 50 different things. Concentrate your learning and your capital into a few strategic areas until you achieve mastery.
The next obstacle, cynicism, is closely linked to that unmanaged fear, isn't it? It's easier to tear things down than to build them up.
Unchecked doubt and fear, that's what breeds a cynic. Cynics specialize in criticism, winners specialize in analysis, and the crucial distinction is that analysis allows a winner to see opportunities hidden in the details. What went wrong? Why a deal failed, how to make it better. Critics only see the danger and use their doubts to rationalize their own inaction.
Yeah, critics often focus on their I don't wants, what they want to avoid, instead of what they actually want to achieve.
And the sheer persistence required to overcome that cynicism is highlighted by the famous Colonel Sanders anecdote.
A perfect example.
He was traveling the country trying to sell his chicken recipe to restaurants, and he was turned down 1,009 times. Think about the emotional weight of that level of rejection. The cynics and critics were everywhere. But he persisted, and he became a multimillionaire after the age of 66. If he had listened to the fear and the cynicism of the crowd, he would have quit on rejection number 20. Winners just push through the doubt.
The third roadblock, laziness, is often not about physical fatigue, but mental. And the suggested cure is provocative, embracing a little greed.
And it's not greed in a predatory sense.
Yeah.
It's the strong, driving desire for something better, for a better life. This is the cure for mental procrastination. You need to activate the WIIFM question. What's in it for me? A person has to take the time to sit down and honestly ask, what would my life truly be like if I never had to work again? What could I do with that freedom?
Without that clear, desired vision, progress just stalls. And Rich Dad saw the phrase, "I can't afford it," not just as a statement, but as the first shot in an internal war.
He viewed it as pure mental laziness. The human spirit knows it can achieve anything, but the lazy mind invents excuses. I'm too busy, the risk is too high, or I'm already comfortable. That internal conflict is what prevents people from pursuing the asset column. You have to replace the avoidance of pain with the pursuit of pleasure and freedom.
And that mental laziness feeds directly into the fourth roadblock, bad habits. Specifically, the deeply ingrained habit of paying everyone else first.
This is lesson 7, the difference between poor dad's bad habit and rich dad's good one. Poor dad paid everyone else first, the government, the bank, the utilities, and if there was anything left over, which was rare, he paid himself last. He operated from a position of scarcity and servitude.
While Rich Dad's habit was the complete reverse. He paid himself first, straight into the asset column, even before the government or the creditors.
He did.
That seems incredibly risky, though, particularly for someone operating on a tight budget. What happens if you don't have enough money to pay the bills after you pay yourself? Doesn't that just invite debt collectors and legal trouble?
And that is the ultimate test of financial discipline. Rich Dad was adamant. You still pay yourself first. The goal is not to default on your obligations, but to strategically use the mounting pressure created by those outstanding bills as a psychological tool. This pressure isn't a bad thing. It's an inspiration that forces the brain, that powerful computer, to generate new, creative ways to earn more income to cover those bills.
So the pressure forces resourcefulness. If you pay the bills first, there's no pressure, and therefore no need to innovate.
Exactly. By paying yourself first, you are building your asset column, and critically, you are reinforcing your own financial discipline. You get financially stronger, both mentally and fiscally. If you pay yourself last, other people, bosses, creditors, the government, they push you around because they know they're prioritized over you. You become weak because you lack the self-control to prioritize your own future. This is the #1 delineating factor between the rich, poor, and middle class.
Finally, the last obstacle is arrogance, which is truly a guaranteed way to lose money.
Arrogance, in this context, is defined as believing what I don't know is not important. It's used as a shield to hide ignorance. The arrogant person will just bluster through discussions about complicated investments or refuse to hire an expert rather than admitting they don't know the specifics. Rich Dad always said, "What I know makes me money. What I don't know loses me money." If you are ignorant in a subject, be it real estate law or stock market mechanics, your only defense is to educate yourself immediately. Seek an expert, read a book. If you choose ignorance, you choose loss.
Okay, we transition now from managing the internal roadblocks to the path of mastery, the actual tangible steps for application, which Rich Dad outlines as the 10 steps to awaken financial genius.
Right, and he starts by smashing the myth that it takes money to make money. He argues that's the thinking of the financially unsophisticated. Wealth acquisition is easy if the foundation is strong, but it absolutely requires determination to get through that initial period of wobbling and uncertainty.
The single most important first step is step 1. Find a reason greater than reality, the power of spirit. Without a strong why, the work, the learning, and the discipline required to build wealth will just seem overwhelming, and you'll revert to the comfortable status quo of the rat race.
Your reason has to be powerful. It can be a deep hatred of the idea of working until you die, or an intense desire to provide specific opportunities for your family. That reason, that fuel, it has to be strong enough to overcome the pain of failure and the inertia of laziness.
Step 2 focuses on the power of choice. Every dollar that comes into our hand every single day is a choice. We choose to be rich, poor, or middle class with our spending habits. We're choosing to fund an asset or a liability.
And this choice is intimately linked to time, which he considers your most precious asset. Rich Dad chose long ago to be rich, and he commits to that choice every day by prioritizing education, reading, seminars, networking. You have to invest in your mind. Just because you bought a small asset or two doesn't make you an expert. The investment in your financial IQ has to be continuous.
And we circle back to self-discipline in step 5. Pay yourself first, We established this as the #1 delineating factor. If you can't get control of yourself and maintain discipline, you will never get rich.
Never. Because the world, the government, the creditors will always prioritize their own claims on your money. And Rich Dad provides 2 practical rules for successfully implementing this self-discipline, especially when you're just starting out. Rule 1. Keep expenses low and build assets first before you buy luxuries. The goal is to avoid getting into large debt positions that force you to prioritize the bank over yourself.
And Rule 2, which ties directly back to using pressure as inspiration. When you're short of money, do not dip into your savings or investments.
The temptation is always there. To liquidate a small asset or pull money out of the brokerage account to cover a temporary shortfall, you have to resist it. Use the pressure, the bills, the overdue notices to inspire your financial genius to come up with new ways of making money. This constant cycle of challenge and solution is what increases your financial intelligence far faster than just reading a book.
This feeds directly into Lesson 6. Work to learn, not just for money. Job security is far less important than learning valuable, transferable skills. In a fast-changing world, it's not what you know that counts, because what you know is often obsolete quickly. It's how fast you learn that becomes your most priceless skill.
Financial freedom requires a breadth of skills, not just depth in one profession. If you want to move into the B&I quadrants, you need to be proficient in more than just the product or service. You have to be a good learner, a good seller, a good marketer, a good teacher, and a good student. This prepares you for any pivot or change in the market economy.
And finally, Lesson 10, the power of giving. This seems counterintuitive when you're trying desperately to conserve cash and build wealth. Teach, and you shall receive.
Rich Dad believed firmly in tithing and giving money, even when he was short, because he understood the underlying law of reciprocity. If you want something, you first need to give. If you want money, you give money, trusting that it will come back in multiples. If you want sales, you help someone else achieve their sales count. This isn't just a spiritual or ethical belief, it's a fundamental principle of mindset.
He used the analogy that the world is a mirror of you. If you want smiles, you have to smile first.
Exactly. And if you want to learn about money, teach it to someone else. The act of teaching forces clarity, and a torrent of new ideas and deeper understanding will come back to you. It's an intellectual feedback loop.
Our entire conversation today has really centered around moving from trading time for money, the left side of the equation, to having money work for you, which is the right side. And the final distinction to visualize this shift is the analogy of pipelines versus buckets taken from the cash flow quadrant.
Yeah, let's clearly define the quadrant ESBI for anyone unfamiliar, because this diagram summarizes everything we've talked about.
Please do.
Okay, so the E is employee. You have a job, you work for the system. S is self-employed or small business owner. You own a job, and you are the system. B is big business owner. You own the system, and people work for you. And I is investor, your money works for you. The goal of financial mastery is to successfully transition from that left side, E and S, to the right side, B and I.
And the analogy vividly illustrates the difference in financial security. The man who hauled buckets versus the man who built a pipeline.
The man hauling buckets, he represents the E and S quadrants. He's trading time for earned income. He works hard, he gets paid well, but if the work stops, he gets sick, the economy shifts, he takes a vacation, the income stops immediately.
His financial security is tied entirely to his physical presence and labor.
But the man building pipelines represents the B&I quadrants. He spends his initial time in capital building system assets that deliver passive and portfolio income.
And once the pipeline is built, the cash flows regardless of his physical labor or presence.
That's the difference between job security on the left side and financial freedom on the right side. The rich are fundamentally pipeline builders. They're focused on systems and infrastructure that generate wealth automatically.
So what does this all mean for the listener? For you, who's perhaps sitting in that E or S quadrant right now, ready to make the jump to B or I?
It means that every day, with every single dollar you spend or invest, you are making a conscious choice to be rich, poor, or middle class. You are given 2 great gifts, your mind and your time. It is up to you, and only you, to determine your destiny by how you use them.
So you have to choose to invest in your mind and learn how to acquire assets.
You have to. You have to understand that the idea that money is fixed and tangible is a trap. Money is an idea, and a well-trained, disciplined mind can create endless wealth.
The ultimate path to mastery, therefore, is not about finding the perfect deal or having a large amount of capital to start with, but about mastering the emotional and intellectual roadblocks that prevent you from applying simple financial literacy. The battle is internal, and the prize is freedom. This concludes our analysis for today. Apply these truths to your mind, and we will be back with a new episode of Pure Riches soon.